You are listening to Keystone's Stock Talk Show, episode 218.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
We have a great show planned for you this week. We start by talking about my interview this past week on Money Talks with Mike Campbell and our upcoming electrification special report. We will also talk briefly about Meta's launch of the Twitter competitor Threads, as well as I will talk an interesting takeover bid from death services company Park Lawn Corporation on the TSX, symbol PLC, of the company Carriage Services Inc., CSV, on the New York Stock Exchange. Both companies we have interviewed in the past. Aaron answers a viewer question on AZZ Inc., symbol AZZ on the New York Stock Exchange, an industrial company that provides metal galvanizing and coating solutions to a number of end markets, including infrastructure and renewable energy. The company just reported strong Q1 results on Friday with 89% growth in revenue, 63% growth in adjusted EBITDA. Aaron will let you know if the company is a potential opportunity. Brett has put together an interesting segment on earnings quality and how it ties into the valuation of a company. The topic comes up because on the show, we commonly highlight certain adjusted earnings metrics within public companies that they report on that we do not necessarily agree with. And a simple explanation of this is now in order. Finally, fresh off a weekend wedding, if it was his or his friends, we are not yet sure. Brennan rips into a fellow Canadian podcaster after viewing an ad for an easy ETF portfolio using BMO's ETFs. So let's get to the show. I got my co-hosts here, Aaron, and the Killer Bees, Brett and Brennan. How you doing, Brett? Aaron, you're just back, right? You had a little vacation.
Physically, yes. Mentally, I'm still on vacation.
Are you ever mentally anywhere? Really? That's it. You're just lofting away in the clouds.
I had to come back a little bit early because I heard that the podcast was falling apart, and
it's true. Isn't this just an AI representative? It's not even you, is it? It's
I'm actually on the generated right now. My background is AI generated.
That's impressive. Well, this weekend, I was the guest of honor, I will call myself, on Money Talks with Michael Campbell. I guess we could probably put a link into the email that we send out to anybody who's subscribed to this podcast, send it out to listeners. We could also put a link at the bottom of YouTube, probably, Brett, right? Yeah. And for the show, so you can link to that and listen to the entire episode. It's always enjoyable kind of to guest on that show. Not kind of, it is enjoyable. Mike's a good interviewer. It really lets you kind of talk, get your point across. The interview is usually pretty free-flowing, which is great. This weekend, I updated Hammond Power, symbol HPS.A. We'd recommended it the last time I was on in March of 2023, just this year, 4 or 5 months ago. I've recommended it in October of this year. It was at $16 then. And even back 20 years, if you can believe it, on this show, the stock in the last 4 months is up 75%, 203% since October, and over 4,000% since 2002. So it's done quite well. Mike wanted an update on the company. We went through our current thoughts on Hammond Power, the valuations, and what we do with the stock right now. And that discussion, because the company has played into the electrification boom, it dovetailed into our thoughts on some work we're currently doing right now at Keystone on an electrification report. We're putting this together, compiling individual reports, interviewing management teams right now to give you a broad idea of the type of reports or companies that we're looking at. It's anything that will be influenced by the electrification boom, some from EVs or electric vehicle companies, battery stocks, rare earth companies, electrical equipment, electrical engineering, electrical maintenance, grid software, utilities, electrical components or materials used in electrical components, anything associated with this sector. The report started with around 400 companies. It'll have statistical analysis of around 50 plus and some potential high conviction buys on some companies in that sector that we really like right now. We're trying to find the next Hammond Power. Again, up 615% in the past 18 months. Just electrification stocks, maybe they're well known, maybe they fly under the radar, but they're going to play into this, what we think is a decade long or more boom as the world moves to electric. And I think we'll also let you know what to avoid in the sector. Some of the overhyped companies that really don't have the fundamental cash flow behind the businesses. You may heard a lot about them in this movement, but they're not companies to invest in right now. So we'll talk about all of those companies. And we're working on that right now and interviewing some last companies over the next week to potentially include in that. You guys got any comments on our electrification work right now?
It's been fun to work on so far. I'm excited because I've been tasked with comparing all of the EVs. And like Ryan said, there's some landmines in there as well as, some more quality companies. But, I'm going to make a nice table and outline for clients and anyone who buys the report, all of these EVs. So I've been enjoying going through that personally. That's my 2 cents.
We look forward to your table.
I think one way to look at this report as well is we're casting a fairly wide net originally in terms of, what we would consider as a company that's contributing to the electrification trend. But then within that larger group, we apply obviously a very rigorous criteria of revenue and profitability. But we also kind of look a step beyond that, and we're looking at a group of companies which today maybe don't satisfy that full criteria, but they're interesting growth-oriented companies. And we see them as potentially transitioning into a range where the profitability, the growth, the valuation would be something that would interest us. So there's hopefully some companies that there are some current recommendations that will be in there. So there will certainly be some recommendations, hopefully a couple new recommendations of companies that fit our criteria today. I'm confident in that, but also a group of companies that we want to keep a close eye on that are really emerging and have the potential of being highly profitable over the next couple of years.
Yeah, for sure. And live update, I just got an email to my inbox of one company we're going to set up an interview. So we'll be doing that Wednesday. So remind me after the show, we got to book an interview with one of the companies right there. So we reach out to a number of management teams, set up these calls, doing a call on Wednesday with one of the companies that actually, it kind of reminds me a bit of Hammond Power in that they're, kind of ancillary to the electrification movement, but certainly a part of it. And have kind of been overlooked relative to some of the more high-flying names in the sector. So should be interesting interview, and we look forward to putting that out over the next month and getting that out to clients. Now, I also wanted to talk just briefly, Meta of Facebook, Origins released Threads. So this past week, Threads looks similar to Twitter and lets users post messages, reply to other users, and like or repost messages. The service also lets users of Meta-owned Instagram follow the same accounts on Threads, which could help people add followers, is the way I think they're looking at it. Now, Meta's Threads app debuted a day earlier than expected this past week, offering 1 billion users or more than 1 billion users with an alternative to Twitter. People are growing frustrated with Elon Musk's own social media services. It was a good time to launch it. Threads had been slated to originally released at 10 a.m. Eastern time on July 6th, but the company on Wednesday of this past week pushed forward the countdown clock to 7 p.m. Eastern time on July 5th. In terms of downloads, it has been met with historic early success. Now, Threads actually broke ChatGPT's record for downloads this year. It was just the record happened this year. Now, it reached 100 million downloads in just 4 days. Give you some context on how rapid the user base has grown. Twitter took roughly 3 years to do what Threads did in 1 day. It was a different time then, obviously, but it's impressive to see. Twitter, I believe, has 330 million monthly active users. Twitter's lead, so you can see with 100 million of Threads already. Their lead is narrowing quickly. Now, Threads has a long way to go to reach anything close to the engagement numbers that Twitter boasts. But Zuckerberg certainly launched it amid further frustration with Twitter at an opportune time. Whether it does what Facebook did to MySpace really remains to be seen at this point.
Right. I think really that is an impressive number, 100 million in 4 days. Of course, Facebook is drawing off of what is already a substantial user base from Facebook and Instagram. So what's really important is how does that trend now that it's made its introduction to the existing user base that Facebook has, how does it trend from here, right?
Got to get engagement. Got to have people using it.
Are you going to get engagement? Are you going to get further adoption and growth? But I mean, I'm not really a big Twitter user at all. I don't know a lot about Threads, but honestly, I don't really care. The only thing I care about is the fight that's being planned between Musk and Zuckerberg, right? That's all that matters. That's really Threads is what this whole thing is about. Facebook talked about launching Threads. Musk got upset. He challenged Zuckerberg to a fight. Zuckerberg accepted.
So who's your money on in that scenario?
Well, my money was originally on Zuckerberg just because Zuckerberg trains and
younger, a little more fit. But I think it's 5'7" versus about
quite a bit
6'2",
smaller. He's 155 pounds compared to Musk's, 240 pounds. I'm guessing a lot of that 240 pounds is not, raw athletic muscle. I could be wrong. I don't know.
You dare say.
However, Musk is being trained by GSP, right? So GSP stepped up to train Musk. I don't know, man. I'm just a fan.
So you'd pay to see it, though, wouldn't you? That's the only fight you'd pay to see.
And it's pathetic because I think the whole thing is just a complete joke. I don't really know what it's over. I don't actually think it's going to happen. But if it happens and it's a full MMA match, then I'd pay to see it. Yeah,
because that's what both of them need is more money, more of our money. That's awesome. That it should be free. It would be a public.
Well,
service.
I mean, I'm sure any proceeds that they get would just say would go to charity, right? But Dana White from the UFC was talking about setting up a pay-per-view, so I'm sure I'm sure a lot of people will dish out the money.
Yeah, and just
what do we got here? Brennan's got a slide.
Yeah, I've got I came across
for you
this,
listening on the podcast. Brennan's putting up a slide here.
Yeah, I came across on Instagram or across this that Yahoo Finance posted, and I mean Ryan already kind of went over the numbers and how quick, months to reach 100 million global monthly active users. So realistically, Threads put up tremendous numbers here, like basically just in a few days reaching 100 million global monthly active users. And as well, something that's important to note is that Threads isn't actually available in the European Union right now, because of I believe because of regulatory concerns. So they basically are leading the pack here with monthly active users, or the time to get to 100 million without the European Union. And I think that it is crazy that they are beating ChatGPT as well as TikTok. I mean, I still have never downloaded TikTok, but I know that it is so popular among young kids. And I mean, it's quite interesting.
Starting with that base has to help massively.
For sure. Yeah. And, like you guys just said, it really depends on, okay, they've had a first good few weeks. Let's see really what happens, going forward. But I mean, it seems like, Zuckerberg almost thinks that the changes at Twitter maybe are opening up some people to switch. So I guess we'll see.
I don't know. I'm looking at this graph. I don't know what it has to do with the fight, though.
Oh, it has nothing to do with the fight. I was just jumping back.
Get it off the screen. No, I'm joking.
No, we want to see the fight. Yeah, I think Thread's going to be a cool enough name.
Perspective, what Zuckerberg's doing is smart because he's seeing an opportunity here right now where people are loving to hate on Twitter. I mean, they always have to an extent, but Musk's ownership of it has made it polarizing. It's actually made it like politically polarized. So there's an opportunity to like grab some market share. A lot of people now want an alternative to Twitter. They're only going to take that alternative if it serves them to the same extent, right? Like Twitter is a very useful tool for a lot of people, whatever they want to say about it, whatever they want to think about Musk, right? And I think those people will continue to use Twitter until there's a viable alternative. But for Facebook with their existing user base, their existing infrastructure, to strike now and try and steal some market share, steal users away. It's a good time for them to try.
And it will it come down to the name? Is Threads a better alternative? Like there's alternatives out there like Mastodon or something like that now, but
I think it's
who's
tough.
going to say I'm going to be on Mastodon? Oh, it's too
Twitter.
large of a name.
Even for Threads,
stupid.
even for Facebook,
Sorry.
I think it's a tough uphill climb because these social media platforms, the usership is really sticky. Like when you're used to using it, you've got it, it's already developed that critical mass. You've got your network in place there. It's difficult then to just move to another platform.
It is interesting to me how if you look at the release of this and the press release that released it, they really associated it with Instagram versus Facebook. Like I think I read an article with something in the name of 40 mentions.
Like you and me.
Yeah, 40 it's true. 40 mentions of Instagram before they even mentioned Facebook. And they mentioned Facebook, I think, once or something in there. Meta did. So it's interesting how they're positioning it versus, is this going to be Twitter for a younger group? I don't know where the demographics skew for Twitter, but I would think it would be, not as old as Facebook, but I would think it would be on the older side. And maybe they're positioning this to be, a younger audience that it skews towards. But it'll be interesting how many people switch over. I was going to ask too, have any of you signed up for Threads yet?
Nope.
I don't,
because I was going to do it.
I'm a bad example. I don't use any of those. Like I have a Facebook account, which I almost never use. So I never use Twitter. I do.
He's
have
a bad
Twitter
example
account,
of a human being. You're AI. You're not even really here. That's the thing.
I don't exist. Yeah. So I'm a bad example, right?
It's true. Are you two going to sign up?
I'll sign up.
You guys are millennials. So
I think we're the demographic. We're the older than the TikTok, younger than the Facebook audience nowadays. So we're that.
Brennan and Brett are the new generation. They're the next generation, right?
Yeah. Brennan had his wedding this past weekend, so he had something else to deal with, right? You were in a wedding. I knew you bought a suit. Party. I wasn't. Yes. Party.
I got a nice new suit. And the wedding went well. But going back to Musk.
You don't want to talk about your wedding.
We're gonna have to go to a conference so I can see this new suit.
Yes. But going back to Musk and Zuckerberg fighting, I think that we should get maybe a tag team match here where me and Dunn are versus Ryan and Brett. I think that
sure.
I'm on Dunn's team. He has MMA experience. I know how this works.
Dibs. I call Dunn.
I have hockey fighting experiences.
Yeah, well, if we do this on ice, then I'm on Ryan's team, but anywhere else.
Classic.
All right, let's go into, now that people are bored crapless about our banter here. Let's, I saw an interesting bit of news.
90% of the viewership.
Yeah, it's true. Point, so. Saw an interesting bit of news on a company or a couple companies. One company we monitor and one we interviewed in person recently, interviewed them at the Roth conference just coming out of COVID. The news involved a leak on a potential deal between TSX listed Park Lawn Corporation PLC on the TSX and New York Stock Exchange listed Carriage Services Inc. CSV on the New York Stock Exchange. Now, both companies provide funeral and cemetery services and merchandise. Carriage is in the United States and Park Lawn is in Canada and the US. Now, the news here was in late June, Park Lawn has just now confirmed a rumor of a preliminary non-binding offer to acquire Carriage. Carriage had recently announced a strategic review process, so it's not unexpected that somebody would be looking to take them over. Carriage's shares rose from the $27 range as the news was leaked to the $34 range as this was confirmed. The source of the leak, however, has not been confirmed to our knowledge. The details on the non-binding bid as per the leaked bid letter, it was an all-cash offer, $34 per share, which was about a 25% premium to at the time of the letter when it was issued. The letter actually came out on June 13, and the leaks happened after that. The bid letter indicates that Park Lawn has a private equity partner to help finance the offer. Now, that private equity was disclosed as Brookfield Asset Management. No details are available regarding the financing structure, but Park Lawn noted that no public equity financing would be required. The bid letter points to a good strategic fit between the two entities, notably complementary footprint. There's low regional overlap between their U.S. businesses and meaningful synergies. They talked about synergy opportunities in the letter, but there's no details in that regard. Now, often these deals take months to come together, so one might expect that talks right now would still be at a very early stage with less due diligence really executed. However, as Carriage is a public company with publicly reported financials, deals can come together between two public companies a little bit faster because you can look at years and years of financial statements as opposed to a private entity where you're going to have to request those and look at them with a little more scrutiny. Now, it's interesting that both death care companies have been experiencing weaker results in recent quarters, trying to find a new normal post-COVID. Death rates were higher during the pandemic, and they are facing tough comparable periods near term. You can look at Carriage's Q1 results. Revenues decreased 2.5% to $95.5 million. EPS declined 43% to 57 cents per share from $1 in Q1 of 2022. Now, while Carriage's stock has surged on the takeover speculation, it is still down 13% over the past year and 48% from its 2022 highs. The stock trades right now on a valuation basis about 15 times its expected EPS for this year. Given the lack of current growth, it is likely more than fairly valued near term. Now, there is some potential for some back and forth here between the two companies, and the ultimate price may be higher than $34. We do not see significant upside unless another death care company really wants the asset and is prepared to kind of reach higher than the price that's being offered right now. It could be an opportune bid by Park Lawn, but I am certain the company is not pleased with the leak that came out here today in the last couple of weeks. So an interesting bid and leak here on a company. Again, one that we've monitored. We've interviewed Park Lawn in the past as well, but we've also interviewed Carriage in person.
So if they find out who, like, this is just a question, if they find out who leaked it, I mean, that person will probably be penalized or some kind of action will be taken against them, or not really. Like, have you seen this?
Yeah, I mean, I haven't seen any penalties issues. I mean, there's little teeth in the public markets. I mean, somebody could be dismissed, right? Like you would think if somebody forwarded
if it's an employee of one of the companies,
then perhaps there could be some securities investigation or something like that.
A legal criminal issue, I wouldn't.
No, likely not. But I mean, if somebody tried to profit on it, right? Like, then you could have, like, if it was insider trading based on this information, then you could have.
So if somebody owned the shares, leaked it, then sold into the increase in the price, then that would be illegal, certainly.
Yeah. So it's also, when you have a deal like this, you want to be negotiating,
this is a huge deal for Park Lawn, because Carriage actually, I think, has slightly larger revenues. Park Lawn's revenues, I think, were in the range of like 350 million last year. Carriage is just slightly above that. So this is a massive transaction. So one of the things I remember, when we had the interview with the management of Carriage, we spoke to them a little bit about Park Lawn, because Park Lawn is a company we've been covering up here for a while. One of the differences that I noted was that the growth of Carriage was much lower, and also the debt leverage of Carriage, I remember, was certainly on the high end. So you had mentioned 15 times earnings, but when you factor in debt, I mean, if you're going to do an EV to EBITDA, that's going to be. For me, when a company makes a massive transaction like this, there's a lot of risk, right? Like, I'm not going to look at this and run out and buy Park Lawn. That's for sure, right? It's a company. I mean, it has a great track record over time, weaker in the last year or two, but with a transaction this size, I'd want to see the smoke clear. I'd want to see the details. How much debt are we looking at? Because this could be something that really makes or breaks a company, probably in a lot of cases more likely to break it, depending on what the deal actually looks like at the end.
Yeah, you'd have to see the financing terms and everything like that. Like, capital is far more expensive right
But
now.
imagine, I mean, for Carriage to want to sell, they would need to be getting a decent premium.
Yep. Yeah, is 25 enough to where it was trading, and and yeah, we'll see what happens going forward. I thought it was interesting because again, we've sat down with management team in person in terms of Carriage and talked on the phone in the past with Park Lawn, and you don't often. I mean, you think there is leaks. You don't often see a company come out and say like, "Oh, this was leaked. It got out. We're now going to announce this," because it does still look like it's preliminary in terms of the deal right now. Usually, the announcement comes out when the deal is, is agreed to by both parties. I mean, there are times when a management team will put out an offer if the other side is not amenable, and more if it's a hostile bid and they're trying to get shareholder support. That doesn't look like it's the case here. It just was a leaked deal. So let's move on. Aaron, you're going to talk about AZZ, a company that provided or posted some fairly strong numbers over late last week.
Yeah, they've had a very strong Q1, and that's after a strong fiscal 2023 as well. So this is a company that I thought it would be interesting to talk about it just as well because it does fit into the electrification theme. And then with them coming out with results, very strong Q1 results last Friday, certainly something that's worth reviewing here. So the company AZZ Inc., which under the symbol AZZ on the New York Stock Exchange, and it's about a $1 billion market cap company. So this would be considered a small cap in the US, $41 share price, 1.6% yield. And what they do is they're an industrial company and they provide various services to different end markets, but it's essentially galvanizing and coating solutions. So galvanizing and coating of metal products is typically done to help deal with things like rust and corrosion, typically for steel, as well as other metals, but primarily steel, I believe. So this is an interesting company because they do, as I said, serve some interesting end markets. Taking an excerpt off the company's website, they mentioned that over the past 60 years, they've been developing comprehensive coating processes to address the challenge of aging infrastructure. So aging infrastructure, this is a theme in the US, which we've invested in through other companies. It's well known that there is a major deficit with respect to spending and investment in U.S. infrastructure that has to be reconciled. So more money is going into it, and that just means roads, bridges, other types of like the power grid, other types of institutional infrastructure as well, transportation infrastructure. There's been an underinvestment in the space, so trillions of dollars need to be invested over the next several years. Right. So the fact that it services this industry and, of course, galvanizing and coating, when you're talking about aging infrastructure, you're essentially trying to get the most you can out of your structures so that they don't corrode or rust. But in addition to that, they also service other areas where the company believes that there's secular tailwinds. One of those being the renewable power sector. So they provide their services to the renewable space. So infrastructure renewables fits a little bit into the electrification. Certainly some interesting, attractive end markets here. Looking at the stock price, it's really kind of traded flat over the last year, but even over the last 5 years, some ups and downs, but really kind of ending more or less in the same place. Now, the question is, are they ready for a breakout now? Are we going to see something different in the share price performance given the strong results recently? So let's take a look at those results. As I said, on Friday, they released their Q1 results. Very strong growth in revenues, up 89%. We've seen some gives and takes on the margins here. So gross margin was actually down 420 basis points to 24.8% compared to 29% last year. But they substantially reduced their selling, general and administrative expenses relative to sales, down to 8.1% from 15.5%. So operating margins were up 330 basis points, but adjusted EBITDA margins were down 360. So a lot of gives and takes there. But adjusted EBITDA did grow about 63%, 18% growth in adjusted net income. Only though very muted growth in adjusted EPS, only 3.6%. And a lot of that comes down to an increase in the weighted number of shares outstanding. So when we break into these numbers a little bit to see where the strength is coming from, there's really two segments to the business right now. There's metal coatings and there's pre-coat metals. So metal coatings, this is, from what I can tell, you're coating metals after the fact. Pre-coat is when you're coating them essentially at the time of construction. So really, it's the pre-coat metal segment that delivered this growth. If we look at operating income, it was about flat in the metal coating segment, up about 3.3%. But pre-coat metals operating income was almost $38 million compared to only $6.6 million, right? So this is really the segment of the business that's been driving those returns. And no surprise, the company actually acquired its pre-coat metals business in 2022. So this strength that we've seen in the current year was really the result of primarily of an acquisition. And Q1 of this year, that was the first full quarter of contribution from this acquisition. The company also noted a couple of other things, such as successfully resolving issues related to excessive customer-owned inventories, which allows them to improve production efficiency, better manage their supply chain, as well opportunities in converting customers from post-paint to pre-paint solutions in various industries. So the pre-paint, of course, being the pre-coat metals business. So when we look at the historical track record of this company, revenue over the last 10 years, there's been a lot of ups and downs. Previous to 2020, revenue more or less, there's consistent growth over time, but not consistently. So this does look like a cyclical business. But then in 2021, they actually divested a major part of their business. This was the infrastructure solutions business. That isn't an area that they wanted to be in long term. So that resulted in a decline in revenues from about 1.06 billion down to 480 million in 2021. And then in 2023, we saw huge growth, fiscal 2023, huge growth in revenues from 525 million to 1.32 billion. And that was due to the purchase of their pre-coat metals business. Now looking at 2024, the company does have guidance. At the midpoint, they're looking at about 1.48 billion in revenue. So going through the guidance here on the sales side for the current year, they're looking at revenue growth in the range of 6 to 17%, adjusted EBITDA growth in the range of 12 to 22%, and then adjusted EPS between 385 and 435, which relative to last year would be about 11 to 25% growth. Taking a look at the balance sheet, there is a fair bit of leverage on the balance sheet. This spiked up when they made their acquisition in 2022. So at the close of the acquisition, they had a leverage ratio of about 4.2 times. They've since reduced with their free cash flow. They've reduced the debt balance. In Q1, for example, they reduced it by 20 million. But they've now gotten that leverage ratio down to about 3.5 times. I still consider that on the high end, but not grossly excessively high. It's at least trending in the right direction. And the company is targeting a range of 2.5 to 3 times long term. So I would consider that a reasonable range. I'd probably want to see it more in the 2.5 times area, maybe even 2 to 2.5 times. But we're not looking at excessive debt levels here or grossly excessive debt levels. And at least we can see those leverage ratios trending in the right direction. And then valuation looks pretty good based on the current share price. The midpoint of adjusted EPS guidance, we're looking at about 10 times expected current year's earnings. So certainly a discount to the market. I have no issues with the valuation. The valuation looks pretty good. So just summing this up, our take, positive growth. I mean, they are expecting pretty good growth this year. This will be largely organic growth because most of their benefit, they made their acquisition in 2022 towards the end of Q1. So future quarters are going to have that acquisition contribution in there. They have some attractive end markets, which we like. They're deleveraging their balance sheet, the low valuation as well. Now, on the opposite side, we still think even though the balance sheet has been deleveraged, the debt leverage is still on the high end. There's also a wide range in the guidance in terms of what they're expecting. So it's really, it's really hard to say where they're going to come in. But 11 to 25%, even on the bottom range, 11% adjusted EPS growth looks fairly reasonable. I will also say that just the recent history of the company disposing of such a substantial portion of the business, as well as making that very large acquisition just recently, that certainly adds to risk. It makes the business difficult to analyze. But overall, I think that this company looks interesting. It's something we're adding to the monitor list. We're going to continue to do our research on it.
Yeah, it's an interesting business. That growth quarter was tremendous on the top line for sure. And I guess the debt, like you said, is an issue. So I think it's a good summary of it to see if there is continued growth going forward. I mean, I looked at analyst estimates going out. Like you said, there is growth expected this year, but obviously it's slowed from what we saw in that quarter. Mm-hmm. Any comments, you guys, or do you want to move on?
Yeah. I mean, on the per share line, it wasn't that impressive at all.
Not that
We're actually looking for an acceleration of per share growth, which is good to see.
Bottom line, or top line slowing.
Top line slowing, bottom line per share accelerating. Yeah. But whenever you make such a large acquisition, there's only so many unknowns when it comes to integrating it. And they're still in the process of integration. I would say perhaps the latter end of the process, but we're about a year out from where it was acquired, and this is effectively half or more of the revenue. So there's certainly some risk involved in that, and it's good to see just over the next couple quarters, are they able to hit these targets? Because as I said as well, there's a wide range on the targets.
Yeah, I mean, probably sensitive to the overall economic cycle too. So
I would think so, absolutely, as most industrial businesses are.
Yeah. All right, Brett, you wanted to look at earnings quality. We talk about, looking at companies' earnings, cash flow on a weekly basis. You want to look at, some of the items that maybe we like to remove out of reported earnings and just get into how we look at a business in terms of their cash flow and their earnings statements.
Yeah. So I'm really going to talk about earnings quality and like how it ties into valuation of company. The topic really, like Ryan says, it comes up because we commonly highlight things when we don't like when they're in earnings, especially adjusted earnings or other metrics that companies report. So first off, if you're not aware, earnings quality, if you look online, there's slightly different wording and definitions. I'll really define it here as earnings quality is how reliable earnings are for the current and future quarters, as well as how persistent their earnings are going forward. Simply how well the financials represent the company in its current and prospectively in its future state. The need for analyzing earning quality is really due to our accrual accounting system versus just pure cash flows. Accrual accounting attempts to reconcile these cash flows with the actual operations of the business, but because cash flows are really just lumpy. A basic example of this, a very basic example, I should say, is if you purchased $80 of inventory in Q1 but did not sell it, under a cash system, you'd be down $80. Where under accrual accounting systems, you don't account for it until the inventory is sold, as you match the cost with revenue when it occurs. So in the next quarter, Q2, if you sold the revenue for $100, you'd recognize $100 in revenue, and then you'd recognize the $80 cost then, as well as the $20 in gross profit. Really, accrual accounting is just trying to smooth out the revenues and costs to match the reality of the company's operations. Its cash flows, they're just lumpy and don't always represent the company's operations within that time period. Because let's say another example, if you got an upfront payment that's like 90% of the company's revenue for the year, but it's all in one quarter, you'd be realizing that all right away, which obviously that's not realistic. But unfortunately, accruals just require estimates and judgments, so they can be inaccurate or even potentially be manipulated. So the issue is as well, management actually has incentives to make earnings look good, as well as they can. So you have a system that is able to be manipulated, and the party who controls much of the process being incentivized to manipulating earnings. So obviously there's been many issues with that in the past. Two of the largest examples of extremely low earning qualities ending in bankruptcy are Enron and WorldCom. Part of Enron's fraud was using mark-to-market accounting, which is normally reserved for financial institutions, and they use it to inflate their earnings by having future estimated cash flow. So there's an estimate represented in current earnings as a present cash flow, vastly increasing earnings with little relying on with little evidence of like the future earnings and cash flows coming through, and it's all just in the future, not at the present, but they were saying it's in the present. Whereas WorldCom, they capitalized expenses, which effectively means they realize over time, propping up current earnings. So there's two different cases, very well known. You can look into them in depth more if you want to, but neither WorldCom or Enron had cash flows. So they'd be low earnings quality just because of that. Standard, when you have that big gap between reported earnings and cash flows, that can be a really strong sign that you're having earnings manipulation. But more commonly, and probably more important to us, is earnings manipulation is not completely fraudulent companies. The term earnings management is when a manager manages the company's accrual to really fit its needs or the manager's needs. As I mentioned before, accrual accounting really requires estimates. Some of those items have high management discretion, so the management really gets to choose what they're going to do with it. A couple of examples of this is accounts receivable for the portion of the accounts which the customer who paid for the goods or should pay for the goods, they don't pay, so you might have an accounts receivable write down in the future, and they have to estimate effectively how much that is going to be written down and how much they're actually going to receive. Inventory, how much should be written down or kept at the current value. Property, plant, and equipment, where the management needs to estimate the life of the asset, which impacts the depreciation, which impacts the depreciation expense, which if they have a long life when it should be a short life, that would increase earnings. And of course, many more. All these actions are within GAAP principles, but are highly dependent on managerial decisions, which allows the manager to manage or massage earnings to fit what they need for the quarter or set up earnings for the future quarters. Managing earnings could be self-interest, such as just hitting a bonus target, profit from insider trading, or for the company's sake to issue shares at a higher price. That is not to say these estimates can't be just changed in good faith, but it's not always clear if they are in good faith. For example, current one in their most recent 10-Ks at the start of the year, Alphabet, the parent company of Google, just increased the estimated life of its servers from 4 to 6 years, and other related equipment from 5 to 6 years, meaning depreciation expenses lowered about $988 million, and after the tax adjustments, net income by increasing by $770 million, or about 6 cents in the last quarter, increasing their last quarter's EPS by about 5%. Even though nothing really changed for the company, they literally just changed their estimate. That's all they changed. 5% increase. That's better growth than some companies do just by changing an estimate. So is it in good faith? Were the initial estimates just wrong and they need to update them? Or were they doing the proper thing? You can't really tell in this situation. Further, let's shift out of GAAP earnings, which are rule-based, but you can kind of shift around them, to non-GAAP metrics, which are becoming more and more common. Non-GAAP earnings really allow for management discretion just to do what they want. They include and exclude what they want to report. Common metrics like EBITDA, adjusted earnings, free cash flow, and many more. They are commonly reported these days, and especially in press releases. S&P 500 companies who report at least one GAAP metric increased from 59% in 1996 to 94% in 2020, as well as they now report from an average of 2.5 in 1996 metrics, which is now 7.5. So they're reporting their adjusted EBITDA, their adjusted earnings, and so on, instead of just a couple of them. The pro of non-GAAP earnings is they can potentially better represent the company's operations, such as removing one-off impacts like acquisition costs, but also they do decrease comparability between companies because it's not standardized, as well as they increase management discretion, resulting in easy earnings management or massaging, whatever you want to call it. So let's take an example, and I've been using my punching bag lately, NVIDIA, since it was in the spotlight last quarter. Their GAAP EPS was 82 cents versus non-GAAP of 109. The uplift was just primarily due to stock compensation, which contributed about 21 cents of the 27 cents of the uplift. Whereas other companies, they don't issue much stock compensation, or they don't add it back to their adjusted earnings. So that reduces comparable earnings. So if you're comparing NVIDIA with another stock, they're going to look more comparable just because they added it back if you're just using their headline earnings, which you'll constantly see referenced online, even analysts will just straight up use them. And really, let's look at what NVIDIA could have done and it would have been included in their earnings even under this. So they issue shares. They could have issued shares or stock options or warrants in the public market or to a private investor, replicating their stock compensation and paying the employee, which initially was stock compensation, in cash instead. Same dilution, same outlook, but it would be lower GAAP earnings under non-GAAP earnings under them doing that method. But it has the same overall impact. So which one are you going to choose? The point is just, it's purely non-standardized managerial decision, and it's just raising headline earnings, which many people end up using in their valuations, making them more appealing investments. And that's really why we constantly bring up stock compensation as well as other things, even acquisitions we've brought up before. One is a company which is a serial acquirer. They're discluding these acquisition costs, yet they're there every single quarter. Is that really representing their operations when it's these non-GAAP adjustments? Really, I want the takeaway for people to get from this is you need to understand what's going into earnings, and especially non-GAAP earnings, because they are just blatantly quite different than what they should be, and a lot of times they are just propping up earnings. And yeah, I guess open it up to you guys.
Well, I love the topic of earnings quality because, we talk about earnings, we talk about price to earnings multiples, but ultimately, the first step is, do we trust the earnings? Is this a real number that actually represents economic value being created? Or is it just an accounting fabrication? And in some cases, it is an accounting fabrication and people still use it. But, there's different ways of looking at earnings quality. One way is to just measure the reported earnings to the cash flow, the operating cash flow, see if there's any major discrepancy there. If cash flow is significantly more than the reported earnings, then that's an indication that the earnings are positive, or the earnings quality is positive. But if cash flow is less or negative, then there may be no earnings quality. That is not something that necessarily works all the time. So in the US, particularly, the biggest difference between GAAP and non-GAAP earnings would be stock-based compensation. And stock-based compensation does not impact operating cash flow in the period that you're actually looking at and analyzing. So then you need to go beyond that and just get into the discussion of, should we actually subtract stock-based compensation? And that's a whole other segment, which we've done in the past as well.
Mm-hmm.
Yeah, it's interesting. There's certain industries where we kind of have to watch the quality of earnings, and one that comes to mind right away is the medical equipment industry, medical services industry, particularly in the U.S., where some of the companies will book earnings, in a current quarter, and they have to still collect that, and some of the collection periods can be a year or two out, and then you either don't end up collecting as much as they originally, like Brett talked about, just being an estimate. Right, you're estimating how much, and you don't collect as much as you originally thought. In some cases, I have seen collecting more, but mostly it's on the lower side, and you really gotta make sure you're trusting either the estimate or just looking at the cash flow, not the earnings that are reported on a business like that. You can get into trouble. All right, we got a final segment here. Brennan, you're ripping a fellow Canadian podcaster. I can't believe you're doing this. It's terrible that I'm just kidding. You're going to look at you saw an ad, right? For exactly. How to construct an easy ETF portfolio using BMO ETFs.
Exactly.
And you're going to go over your thoughts.
Yeah, I don't know if
we have no part
completely
to it at
ripping her, but I will.
That's what you'll be doing. We'll be defending her. That's what we'll be doing.
Yes, exactly. So yeah, while I was on Facebook, and yes, from our previous comments, I actually do use Facebook still. So while I was on Facebook,
right?
I'm old. No, but while I was on Facebook, I came across this ad from Jessica Morehouse, who has a Canadian podcast for an easy ETF portfolio using BMO's ETFs. And knowing that big bank advisors and brokers tend to over-diversify their clients' portfolios through hundreds of stocks, I thought that I would dig in to see what kind of portfolio composition we would actually end up with if we did invest in an equally weighted average across these 5 ETFs. So let's just quickly look at these 5 ETFs, and then I will summarize the portfolio at the end. And just a note, I have gotten all of the info from these ETFs directly from BMO's website. So the first ETF here, ZCN on the TSX, which is BMO's S&P TSX Capped Composite Index, which essentially aims to replicate the return of the TSX index. And like the Canadian market, it is heavily weighted toward financials and energy stocks. The next here we have ZSP on the TSX, which is BMO's S&P 500 index, and this just tries to track the S&P 500, or in other words, the US market. Then we also have here ZEA, which is BMO's MSCI EAFE index, which tracks the markets in Europe, Australasia, and the Far East, which is what EAFE stands for. And then as well, we have ZEM on the TSX, which is BMO's MSCI Emerging Markets Index, which is pretty self-explanatory. It's just emerging markets. And then last, we have BMO's Aggregate Bond Index ETF, which invests through Canadian government and corporate bonds. So, in summary here, if one was to invest in these 5 ETFs based on an equally weighted average, you would end up with a portfolio that holds over 2,300 stocks and just under 1,500 bonds, with an asset allocation of about 80% in stocks and 20% in bonds. Now, first off, with our philosophy of trying to find the next Boyd, Expel, Hammond Power, Water Furnace, absolute game changers for clients' portfolios, I think that this ETF portfolio is way over diversified with over 2,300 stocks. And in the words of Bill Gross, any good investment ideas that are in this portfolio are essentially being diversified away into meaningless oblivion. So even if one name provides a return of 500% or 1,000% or 10,000%, it really isn't going to make the needle move for your overall portfolio. Now, number 2 here, on the fees being paid for holding these ETFs, generally, I do think that they are reasonable. And you can see here, I made a few simple calculations using the weighted average management expense ratio, or MER, which is about 0.148%. And based on some hypothetical amounts that have been invested across these ETFs, if you invested $100,000, you would pay about $148 per year. Or if you invested $1 million, you would pay about $1,500 per year. Now, for the sector and geographic breakdown of the stocks across the portfolio, I think that financials are a little overweight here at just under 20%. And realistically, I think that I would want my portfolio to have more than 25% exposure to the US market. I mean, maybe that's just personal for my own self, as you know, the US is a leader in tech innovation. And I would likely want to limit my exposure to other locations in the world, such as China, which makes up 7% of the portfolio. And although it's quite small, also Russia, which makes up just under 1% of the portfolio. So all in all, for an investor that just wants to ride the markets of the world, I do not think that this portfolio of ETFs is bad. But for someone who actually wants to build a portfolio that isn't over diversified and can position you for life-changing stocks, I would advise that you avoid making a portfolio of ETFs like this. So yeah, I'll open it up to you guys, see if you guys have any comments on this.
It's a couple things. If your goal is just to mirror the markets globally, it's fine. This portfolio is fine. That's what you can do here. Yep. Number 2, don't pay an advisor for this advice. This is something you do by yourself. Don't pay 1% in terms of an advisor, because Brennan talked about the fee there. Their advisors will put you into this portfolio, and if you got $1 million portfolio or even $100,000 portfolio, $200,000 portfolio, you got a 1 to 1.5% overlay fee on that. So it's $1,000 on $100,000, $2,000 on $200,000. If it's 1%, $10,000 that you're going to pay out for advice to go into a portfolio such as this. You certainly don't need much advice to do this, because you're just mirroring the markets. And at least the fees are low, which is good. Yeah. But so don't pay an advisor. But make no mistake, if your goal in the market is to try to beat the market, there's no way this structure can do that. So if you just want to set it, forget it. If that's what you want to do, have some participation in the markets, you could use a structure like this. There's probably other ways that we might want to structure it, but this is fine. It's defensible in that respect. But if you have any goal of trying to beat the market return over time, this would not be the way to go about it, in my opinion.
Agreed.
Well, no, I mean, it's not your opinion.
Yeah, it's not.
There's
it's not an opinion. It's a fact.
Ways, like, I have no problem with this portfolio as a passive investment portfolio. I've said to people, I say, probably you can do it with 2 to 4 ETFs. Some people want to have ETFs that give them direct exposure to foreign markets outside of North America. By investing in the S&P 500 index, you are investing in a lot of companies that are global. So you if you want to really simplify it, you could probably do that with just a Canadian and a US, and then maybe a bond ETF if you want bonds. But there's different ways in terms of strategy of investing in the market. That one way to break it down would be passive and active, right? So a passive investor is somebody who just wants to mirror the market, right? The market goes up, they go up. The market goes down, they go down by about the same amount minus fees, right? So passive investing is for somebody who just doesn't want to they don't want to do any individual stock purchases or sales. They just want to, buy their mutual funds and coast with the market up and down and not have to look at it or think about it really that much. You don't buy and sell, you don't trade in and trade out. It's a long-term strategy. You just go with the market. Nothing wrong with that if that's what you're looking for. Active investing is when you want to actually outperform the market, and you do this almost always through buying and selling individual stocks, right? So active investing gives you the opportunity to generate outsized returns, also the risk that you will underperform the market, but certainly the opportunity to outperform the market and the opportunity to invest in some very unique companies that are doing incredible things in terms of solving problems for society, right? So that's an active investing strategy. Buying ETFs is not an active investing strategy. Buying individual stocks is an active investing strategy. So it really comes down to what you want as an investor. If you're looking to generate those market beating returns and invest in individual stocks or individual themes that you think are going to essentially propel society forward, then you're going to want to focus on individual stocks, or at least with a portion of your portfolio. Now, what some investors will do is they'll do what's called a hybrid investing strategy, and they'll take a portion of their portfolio, they'll put it into ETFs, such as some of these. They'll take a portion of their portfolio, they'll actively invest it. And that way they're getting the opportunity to invest in some great companies while they're remaining widely diversified with the rest of their capital. And what that mix looks like really depends on the investor. It might be 80% passive, 20% active, 50-50, or 20% passive, 80% active. Really just depends on the individual investor. So, but the thing to really understand is that, you don't want to mix, in my opinion, active investment with the same capital. You don't want to try and get wide diversification and invest actively at the same time. If you want to get wide diversification, go with an indexed ETF, low-cost indexed ETF. If you want to outperform the market, you need to focus your capital strategically in strong areas and strong stocks. And when it comes to mutual funds, there are a lot of mutual funds out there that will try to outperform the market while also being widely diversified, and they almost always fail long-term, but they charge higher fees due to their effort to try and outperform the market, which they tend almost always not to do. So, you could, if you have, say $1 million, you can take a portion of that, put it into ETFs, take a portion of that, put it into active management.
Something... Yeah. And again, what I was stressing is, if you're going to use a strategy like this, you do not need an advisor charging you 1%. If you I've seen several portfolios where it's $1 million, $2 million, and they have somebody charging 1% to do this.
Yeah, you don't need an advisor.
Do not do that.
You're
just getting
ETFs
fees
easily in a discount brokerage, and you can just set it up even so that you're purchasing a certain amount every
automatically
month or every quarter. And they're extremely easy to buy. So you don't need to pay an advisor,
so you're basically cutting yourself. You're cutting yourself off at the knees, because you get the benefit of these are they're low cost. But if you overlay a 1% portfolio fee on top of that, you're basically cutting that benefit out. and you're going to significantly underperform the market because of that fee. So if you're going to do this, you can do that yourself with a discount brokerage. And that's what we tell people all the time. And Aaron said, it's active versus passive. If you want to beat the market, you have to use a different strategy. I mean, that's obviously what we provide to clients on a
And you can get pretty
basis.
good diversification in a passive strategy with even just 2 or 3.
Yeah.
ETFs,
I even found it interesting that like some of these funds here also held like
funds.
11. Yeah, exactly. It's like fund of funds, 11.4% of this is in iShares emerging markets. I mean, it's like you could just go maybe buy the iShares if you wanted. I mean, depending on the MER. Another question that I'd have too is, I'm not pointing fingers. I have no idea if she does have some partnership with BMO or, if there is, but, that would be, something that I would, like to know as well, is whether, this is kind of marketing with BMO as well. But
yeah, it could be disclosed right there. And I think there's just some like good educational work on the stuff that's being done. But this portfolio, it's your portfolio, but don't pay an advisor to get this portfolio. In my opinion, you don't need that. And if you want to beat the market, you need to structure your portfolio differently. And we do seminars on that all the time. Yep. I think that's going to close out our show. Any final comments, Brennan? Are you getting married, or was it just a marriage?
It wasn't my wedding. It was my cousin's wedding.
So you're still single?
Yes, I am still.
Listen up, ladies.
Yeah, listen up.
New haircut, new me.
We're putting a ad out there for Brennan right now. There you go. Tweet us or wait, thread us. Do you say thread us? What do we say on that?
I guess so.
You say maybe. Thread, or did it
because
Twitter has tweets? What does Threads have? Is it Threads?
Thanks.
But Threads is Threads or Thread? I don't know, man.
Thread
we don't know yet. We'll figure it out. Thread us.
Yeah, just
we're not even on Threads, but thread us. Brennan's got some nice threads on. That's all I know. All right, that's enough of this. Let's move on. Thanks everyone for listening or watching. If you want to rate and review us on the podcast version of this, do that on iTunes. We'd love to have you rate and review us on there, only if it's positive, obviously. And if you're watching this on YouTube, smash the subscribe button, and we'll keep putting out the content on a weekly basis. Send your questions in for our Your Stock, Our Take segments, and we'll answer those on a weekly basis. If you got any other questions you want to know about the financial markets, we'll let you know on a podcast too, so send those in. As always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.